Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to the final Money Talk of June. It's Thursday the 1st of June. You can also find this podcast on Google Podcasts, Apple Podcasts and Spotify. Just search for Peter Lewis's Money Talk in your podcast app. And we're also on Facebook. Peter Lewis Money Talk is the page there. This podcast is sponsored by SafePro Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's manufacturing activity contracted for a second month in May, while activity in the services sector expanded rapidly, highlighting the uneven nature of the economic recovery in China. The official manufacturing PMI fell to a 5-month low of 48.8 in May from 49.2 in April. The official non-manufacturing PMI, which covers activity in the services sector, came in at 54.5 for the month, expanding for the 5th straight month. JP Morgan Chairman Jamie Dimon warned Wednesday that uncertainty over the Chinese government's policies could hit investor confidence. He told Bloomberg TV in response to a question on China's crackdown on the tech sector and on consultants, if you have more uncertainty, somewhat caused by the Chinese government, it's not just going to change foreign direct investment, it's going to change the people here and their own confidence. India's GDP grew much faster than expected in the first quarter, indicated broad-based growth in the economy. The Indian economy expanded 6.1% year-on-year in the first quarter of 2023. The expansion was mainly boosted by private consumption, services exports and manufacturing. For the 2022-23 fiscal year ending in March, India's GDP grew 7.2%, surpassing economists' expectations and confirming the country's status as one of the world's fastest-growing economies. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Hong Kong-based macro strategist Patrick Bennett. With a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
US stocks fell on the final day of trading in May as the number of job vacancies unexpectedly rose in April, increasing odds that the Federal Reserve will again raise interest rates. However, two Fed officials on the rate-setting FOMC indicated they were in favour of a pause in rate hikes this month. The S&P 500 dipped 0.6% to close at 4,180. It added 0.2% in the month. The Dow fell 135 points, or 0.4% to 32,908. It was the underperformer in May, losing 3.5%. The Nasdaq Composite slipped 0.6%, finishing at 12,935. The Nasdaq finished the month 5.8% higher, helped by a rally in artificial intelligence-related stocks and other technology names. Shares of AI chip designer Nvidia soared 36% in May, briefly making it the first chip company worth more than $1 trillion. Asia-Pacific markets fell on Wednesday. Australia's ASX 200 dropped 1.6%, and for May it was down 3%. South Korea's Kospi reversed earlier gains and lost 0.3%, but for the month it put in a positive performance, rising 3%. Japan was the month's standout performer in Asia, although the Nikkei 225 retreated from its 33-year high and fell 1.4% on Wednesday. The index was up 7% overall in May. Hong Kong stocks flirted with a bear market on Wednesday. The Hang Seng Index tumbled 362 points, or 1.9% to 18,234. That's a new low for 2023. From its January peak, the benchmark is now down 19.6%, putting it almost in a bear market, which is defined as a loss of 20% or more from the recent high. And it briefly breached that level in Monday morning trading before rebounding. For the month of May, the Hang Seng lost 8.3%, and the tech index dropped 2% yesterday, taking its losses for the month to 7%. Asia's worst performing index is the Hang Seng China Enterprises Index of mainland companies listed in the city. That dropped 1.9% on Wednesday, taking its losses from its January the 27th peak to 20.7% and sending it into a bear market. Mainland Chinese markets were also lower. The CSI 300 index of the largest listed stocks in Shanghai and Shenzhen fell 1%, having erased all of its 2023 gains last week. It was down 5.7% in May, its fourth straight losing month, and the benchmark has tumbled almost 10% now from its peak at the end of January, wiping out $1 trillion in value from domestic A shares. The offshore yuan fell 0.5% to 7.1283 against the dollar, breaking through the 7.12 per dollar mark for the first time since November last year. The Chinese currency is down 2.9% for the month and down 3.1% for the year to date. And you can get more details on the latest market movements, which you'll find in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us, as we do every Thursday morning, Andrew Freris, who's the CEO of Ecognosis Advisory. Morning, Andrew.
Good morning.
And also with us is Patrick Bennett, who is a Hong Kong-based macro strategist. Morning, Patrick. Nice to see you again.
Yeah, good morning, Peter.
Let's start with the PMI data from China. Data from China's National Bureau of Statistics yesterday showed China's manufacturing activity contracted for a second month in May, while activity in the services sector expanded rapidly, highlighting the uneven nature of the economic recovery. The official PMI fell to a 5-month low of 48.8 in May. That's down from 49.2 in April. Missed economists' estimates of 49.4. The contraction in factory activity pointed to weakening domestic and global demand. And the official non-manufacturing PMI, which covers activity in the service sector and industries such as forestry and agriculture, came in at 54.5 for the month. That's marginally lower than analysts' expectations, but well above the 50-point reading that separates expansion from contraction. While pointing to the fifth straight month of expansion in services activity, following the removal of strict pandemic curbs by Beijing last year, the latest result is the softest pace since January. Now, Andrew, I'm always a bit reticent about talking about PMI numbers with you because I know you're not a big fan of them. But anyway, what do you glean from this?
Well, actually, for a change, and although the weather in Hong Kong is incredibly thundery and gloomy and pouring with rain, actually, I'm not really convinced the huge amount of attention that has been paid to the PMI, not because I don't particularly like them, but because there are a lot of other numbers that I clear my throat, that they don't look at all in the same direction. Now, PMI is forward-looking. Okay, I stress that. PMI is forward-looking. All the other numbers are backward-looking. In other words, things that have happened. But for example, cumulative industrial production in China has been expanding now, at least for the last 3 months. Okay, and the last number we had was for April, was 3.6%. So I find it's a little bit peculiar that for 3 months it has been expanding, and suddenly in the last 2 months, the expectations have been changing. There is another number which I like, although it is a little bit funny and the markets don't pay attention to that. That's the Bloomberg monthly GDP. Yeah, you heard it, monthly GDP. And that has been increasing, again, for 3 months running, and it's based primarily on industrial production. So, to press the button marked panic because the PMI has come down and it is below the 50, I'm afraid I'm a little bit reluctant. I want to see the Caixin numbers that we're going to get on Friday. And in all probability, they will also be down because they match very fairly closely what happens with the CFLP. So these numbers have left me, let's say, basically uninterested.
Nonplussed.
Yeah, nonplussed, exactly.
Patrick, I mean, you could point to some other things, though, couldn't you, which are rather gloomy, like the trade data, the inflation data, the amount of foreign direct investment going into China. They're all rather pointing downwards.
Look, that's true. Look, what I really take out of these numbers is the divergence between the domestic activity, the services activity, and the outlook for global demand. And I think that's where the threat is for China going forward here. Yes, production has been reasonably strong, but the outlook for demand from the global community under the influence of higher interest rates continues to look very soft. So I think it's going to be a bumpy ride forward. And I think as far as the markets have been concerned, it's a reality versus their expectations. When China came out of the COVID restrictions, thinking that now everything's going to be well. And simply, that's not quite the case, that it is going to be quite bumpy. And I think we need to keep aware of that.
I mean, if you were looking back in January, as some people were, and cautioning, and I remember you were cautioning at the time, don't expect this huge rebound, you're probably not too disappointed at the moment or surprised by these numbers. It's the people that were expecting, this rapid surge in consumer spending, this revenge spending that they were calling it, that are the ones that are disappointed now.
I think that's correct. I see these numbers as as validating the expectations and the warnings that we were talking about earlier this year. And now we still, continue with a fair degree of caution. And again, to repeat, I think the caution is not just domestically in China, but the caution from a global outlook as well. That we're simply not in a repeat of post 2008, 2009, where China is able to lift all boats, including their own. And I think that we're seeing that in numbers elsewhere. And I think we can't just look at China in isolation. We need to look at where their place is within global activity, within global growth.
Andrew, where does the consumer fit into the picture?
Uncomfortably, because American interest rates are not going to come down. As you say, where does the consumer sector stand? I said uncomfortably because American interest rates are not coming down. The European Union has also pointed that they are not planning to cut, and except Japan, that still stays at near zero. Again, let's say major interest rates moves are not necessarily favorable. But I wish you would ask me why on earth the equity and the capital markets are so childish in their behavior right now. I feel like saying, oh, for God's sakes, what do you want? What's the problem now?
Well, we're going to get onto that because I do want to talk about the Chinese markets. But let's just stick with the economic data for a moment. Someone on the programme yesterday suggested handing out stimulus checks on the mainland to consumers, like they've done in other parts of the world in the wake of COVID, like here in Hong Kong, also in the US. Do you think that should be a consideration?
China and elsewhere concerned about indebtedness, and we're seeing more reports of that. So I think that this would only exacerbate those concerns. So I think that the PMI services number suggests that there has been some pent up demand, and the domestic economy is moving along at a fair pace. Notwithstanding, we have to recover the 3 years of very truncated activity. So I don't think that's the way forward at this stage.
Well, Chinese authorities perhaps may have it their own way, in the sense that they tend to be very non-interventionist. And when interest rates are cut by 3 or 4 basis points, it raises a yawn and a laugh. And at the same time, one says, yes, they don't want to repeat what the United States or the European Union did. But on the other hand, they can't have it both ways. They cannot get a 5% GDP growth following nearly 2.5 years of a complete close down on COVID, which apparently actually turned out to be basically not necessary or not incredibly useful.
The policy way forward for China has been and continues to be to access the excess savings that Chinese depositors have. So rather than a stimulus check, is about continuing to manage the RRR, continuing to manage the cost of money for banks, and so to release that money through lending rather than through stimulus checks or otherwise. And I think for now, the lending data that we've seen to date has been very, like the economy, has been very uneven. And I think that's a key figure that I'm looking at going forward.
Andrew, where has all this stimulus gone? Because money supply is at a record high. We've seen total social financing, pretty high as well. But it doesn't seem to be getting into the right parts of the economy. What's happening to it?
Yeah, that's right. As I say, it's been very uneven. We also saw, we saw at the start of the year some repayment of mortgages by consumers, borrowing, of course, or relending or refinancing for the property sector has been a very large sector, or a very large portion of it. So again, it's that unevenness, and I fear, to Andrew's point earlier, about the build-up or about the increase in industrial production, that we're not going to see some of this turn up in inventory in the months going forward.
Andrew, the other issue here is jobs, isn't it? The pandemic restrictions, they've eliminated about 30 million service sector jobs, although some of them are going to come back. It's the youth, it's the young people that seem to be suffering the most from all of this. We've got this horrendously high youth unemployment rate of more than 20%. What can the government do to try and bring that down?
Manipulating the age structure of the population, of course, is a complete impossibility, and neither is changing the educational sector structure. So you produce a lot more electronic engineers and fewer accountants and literature students. It is basically on expanding aggregate demand. And as we have been pointing out, this takes place very slowly, and the best thing they can do is grit their teeth and hope that this doesn't turn out to be a social problem, because it is only 6 months ago that there was a complete volte-face out of the blue and says, forget about COVID, we are off to the races. And I have an insistent nudge, which, of course, I cannot possibly quantify, and it will be very unfair to sort of dangle this, that the 2.5 years created a hell of a lot more damage than we imagine it did, primarily in terms of expectations and primarily in terms of we are going forward now on to. Not that for one moment the Chinese population thinks or expects that they are going to have another clampdown, because this is not going to happen. But the 2.5 years were apparently much harder than we thought they were. There is almost a kind of a cramped reluctance to spend, and hence lower interest rates and making expenditure on housing easier is really not necessarily the way forward. Although, mind you, we now know in the case of Hong Kong, where the government gave people cash, this is not having the kind of effect that the government was expecting to have.
In what way?
In which way? Yeah, well, because the Hong Kongese economy is still very, very dumpy, very flat. Okay, and we had two major sections of 5,000 each, following one after the other, with a little bit more coming now in July.
Patrick, do you think consumer spending is going to get back to pre-COVID levels, or has something changed in the consumer's psyche in terms of the way now they're thinking about their job security, maybe the way forward?
Yeah, look, absolutely. I think that things have changed materially, as Andrew points out. I think the last 2.5 years, not just in China but everywhere, has changed expectations and outlooks. Interest rates obviously are higher. People are more concerned about their future employment. So yeah, I mean it's. Leading a horse to water, but getting them to drink is very difficult. And I think consumer spending is going to be more conservative for some time to come. The so-called pent-up demand, was one thing, but I don't think we're going to see a repeat of that. So I think we're in for a period of stilted growth, which is impacted primarily by tighter monetary policy, which was perhaps too slow in coming, given that we went through these this COVID period.
I think one of the things that people are disappointed in, certainly investors in the markets anyway, is the lack of concrete sort of stimulus. The government's talked a lot about wanting to stimulate consumption and talked about it being a priority, but we haven't seen any concrete policies, have we, so far, to actually go and do that?
No, of course. We've had infrastructure spending, as we saw in China post 2008, 2009. Most of that has already been done. Stimulating consumer demand is all very well and good, but as was mentioned earlier about the lending data in China, interest rates have come down modestly, and what we saw from lending data is that consumers have actually, there's been a bias towards repaying mortgages rather than taking out new ones. So I think that speaks to the conservative nature and the conservative outlook.
Andrew, you were sort of suggesting earlier that maybe you agree with what Jamie Dimon was saying yesterday, that it's actually government policies that are, a large part of the problem that are causing this slowdown. You mentioned specifically, the impact of the COVID policies, but he was also talking about other things like the crackdown on the tech sector, the crackdown that we're currently seeing on consultants, the closing down of the education sector. How much are these policies responsible for what's going on and the sort of the disappointing growth that we're seeing?
I call it a mosaic effect. In other words, it was not something that came like a ton of bricks. It was individual little touches and points. And even in the case of the tech sector, I had at the time disagreed, because tech sector means a lot of different things. There are tech companies that make chips, tech companies that make things with chips, and then there are tech companies that simply do software. And the Chinese government actually extended its control over companies that do software. So, hello, don't, include me out. In other words, it was not that all the tech sector came out under an iron fist. So I preferred a little bit of more nuanced approach. And yes, there were things like the restrictions on the education sector that, again, came suddenly. In other words, it would be nice if there were two buttons on policy. One is an analog and the other is a digital. And I prefer an analog because that comes out in a smooth curve as opposed to an on-off kind of thing. And that there is a few lessons to be learned when it comes to that.
Okay, well, let's get on to the question you wanted me to ask you about the markets. The Hong Kong stocks almost in a bear market. The Hang Seng did briefly fall into a bear market earlier on yesterday. The Hang Seng China Enterprises Index is in a bear market. It's down almost 21% now from its January the 27th peak. Mainland Chinese markets also low. I mean, it's been, Andrew, a pretty dismal month of May for investors, but should they be surprised?
Well, let's take it one step at a time. First, we have the deficit. We have the debt ceiling in the United States. Oh God, we're all going to die. Biden is going to take an off to debtors' prisons for not paying his debts. And well, it's gone. All right. And what has happened to the market? Absolutely nothing. Then the tech side is absolutely booming to the point. Okay, with the II. I mean, the shares of specific companies like NVIDIA are going gangbusters. And then, what's happening? Well, we're all going to die because the robots are going to take over. Okay, and then what's happening between the United States and China? Well, they're sort of quarreling, but not really. And then if you nuance what it has been controlled, and it has been a bit of a tit for tat, it is bad, but it's not dramatic. So my reaction is what do you want? I mean, please, what is it? Interest rates? We know they're not going to go up yet. Sorry, they're not going to go down for the time being. So why are the markets so incredibly gloomy? In other words, there is really not, in inverted commas, pleasing them. I tend to think it is perhaps incapacity to digest and put the data in order. Not because I can do it better than they can, but at least I can observe and lay out what is there and say, well, there is not such a great deal of gloom. And even when we look at the Chinese data, again, my nuance on that is different. So but then on the other hand, Peter, I mean, it's not that I'm right and they're wrong. It is simply an observation.
But are you saying that really you think that investors are being too gloomy in China and that maybe they're missing some things here?
Too gloomy everywhere, basically. In other words, there's no pleasing. I mean, what is there that will make the markets start going up on a consistent increase? And the answer is effectively the tech industry is doing very well. The debt ceiling is over and out. The Fed is perhaps might increase, but perhaps we might. So in other words, there isn't enough to create a gloom and doom situation as it is now. So perhaps I'm missing out something.
Well, Patrick, what are your thoughts? What's your assessment?
Look, I think it's simply due to the cost of capital. The cost of capital for mom-and-pop investors, the cost of capital for professional investors or fund managers, that cost of capital has gone up. So if we look at a long-term stock market index, a global one or anyone you might want to pick, if you stand far enough away from it, it goes from the bottom left to the top right. And that's because growth has over time has picked up, and interest rates have been at moderate levels, sometimes high, sometimes low, and extraordinarily low, for the last 15 years. Well, that's changing. So the cost of capital has gone up, and so now we're seeing ownership of equities change hands, and we need to find a level where investors in sum are happy to be buying again. And I don't believe we're at that yet, because I think we're facing persistently high inflation, persistently high interest rates, and growth, which is going to be challenged for a number of months, still going forward. And when I say a number of months, I think likely another 6 or 12 months.
But if you look in China, interest rates are much lower than elsewhere in the world. They're not going up. Inflation is non-existent, so there's presumably potential for policy response there. You'd almost think that Chinese equities should be the outperformers in the world, not the underperformers.
Well, you would think so, but I think one of the things, or a couple of factors, I think are particularly relevant for the Chinese market. One is it is very narrowly held. Two is that we haven't seen the portfolio inflow to the market, which was a very strong supporter for a number of years, and so we removed that. And again, we're trying to find this new balance level where where investors want to be participating without the foreign investment, and the risk premium to invest in China has certainly gone up in the last year or two. Then I think that we face the uncertainty looking ahead. Of course, a lot of the funding. Has been a lot of funding in the Chinese market as well, as not just out of the domestic market. It has been funded out of international money markets for some time, and that now obviously is changing.
And foreign investors, they've been particularly aggressive in dumping Chinese stocks. One of the reasons I've heard from them is that they just can't think of a reason to be in the Chinese market at the moment. They just can't see, with all the geopolitical tensions going on, they can't find a positive sort of, if you like, stimulus that's going to make the market go up.
Well, that's right. The risk premium has gone up, be that geopolitics or uncertainty over activity that we're seeing now, in the uncertainty or unevenness in the activity. So, if you're an international investor, then your allocation to China has likely or not likely has decreased. Whether that's going to be a valid strategy going forward, I would doubt it. I think there's going to be a level where investors should be participating, and perhaps the ongoing weakness of the currency will allow that opportunity, will allow that entry point.
Andrew, final word to you on this. We're seeing there are some things to be positive about, aren't there, in the Chinese markets? You would almost think that the worst has been priced in here. And China is still exporting. It's got a record sort of trade surplus. And there are things that are looking quite positive about China. So it's a bit odd, isn't it, that people just don't seem to be able to find a reason to be buying and are hitting Chinese equities more than anything else in the world.
I agree, and I have no problem actually, let's say, expounding on my ignorance to say, really, I don't understand why. I am an incredibly close follower of the Aussie dollar, and the Aussie dollar has been absolutely in the dumps. And strictly speaking, one should have said, with the performance of the Chinese economy in terms of the inputs of coal, in terms of the beginning of the inputs of agricultural products from Australia having lifted the restrictions, should be considerably better for the Aussie, and it isn't. Okay, so what on earth is the problem with the Aussie dollar? And the explanation, this is nearly, in fact, what my colleague here is expanding, is, of course, increases in interest rates. In other words, the differential of the Aussie to the United States may very well widen if, in fact, the Fed, as I do believe, will increase interest rates. So it is a little bit of a complex situation, but with, as I say, question marks arising, to which personally I cannot give answers right now.
Okay, well, thank you very much. You heard there Andrew Freris, who is the CEO of Ecognosis Advisory, and then Hong Kong-based macro strategist Patrick Bennett.
Peter Lewis's Money Talk.
I'm joined now by Ross Feingold, who is Business Development Director at SafePro Group over in Taiwan. Very good morning to you, Ross.
Good morning.
You've got a new corporate superstar wandering around Taipei at the moment, I believe. Jensen Huang, who is the co-founder and the chief executive of NVIDIA, a company that's very much in focus at the moment. He's been in Taipei. He's been talking a lot about artificial intelligence, which has rather shaken up the markets anyway.
Yeah, I hope he's not paying a PR firm because he's gotten so much PR coverage in the past few weeks with all this focus on AI and the need for chips that are designed by NVIDIA and his appearance at Computex. So he's been a real all-star of, not just the tech world, but the business world. And something we should also keep in mind, because it's getting a lot of attention, of course, is also the political world, because we see that governments and regulators and politicians are talking about how to regulate AI. But be that as it may, the company has been a big winner, not just its stock price, but the obvious need for chips that it designs. And, they're just the industry leader, in fact, by far. And they outsource their production to TSMC. So TSMC here in Taiwan will be a big winner as well.
I mean, I was going to say, Taiwan's in a good position, isn't it, to benefit from this? Not only is Jensen Huang, of course, Taiwanese, but you've got, as you mentioned, TSMC there. The Chinese economy is really in a very nice position for this explosion in artificial intelligence.
Yeah, Taiwan typically rides any wave of something new in the tech world. So I think back, say, 25 years to the late 90s when suddenly we could burn DVDs at home, and Taiwan was a big producer of storage media, that it was mobile devices, whether 2G, then 3G, tablets. Taiwan, its niche, or one of its niches in the tech world has always been being the outsourced manufacturing partner, and it's something that Taiwan does really well. So yes, to the extent that there's going to be a big spend, whether in the corporate world or by individual consumers like us related to AI, and Taiwan will benefit. But interesting, at the same time of all this good news, and we know that Taiwan's tech industry will benefit, Taiwan's statistical agency actually lowered the GDP forecast for 2023 recently.
But it puts Taiwan in a little bit of a difficult position as well, doesn't it? Because it means that its economy is very much in focus in other parts of the world, and in particular the importance of the Taiwanese economy, the supply chains which go through Taiwan, the chip manufacturers like Taiwan Semiconductor, just how much the world depends upon them. And that's obviously getting the focus of the US and the EU, who want to develop stronger relations, and of course also China.
Well, I would look at it a different way, because that's just part of risk management, and that we hear this from American and European politicians. Taiwan is vitally important. Oh, by the way, for resiliency purposes, could we move some of this manufacturing over to where we are? So we see these enormous subsidies from the United States and Europe to try and get these very expensive semiconductor fabs to be built in either the U.S. or Europe. And TSMC has had ongoing discussions with Germany about building a fab in Germany to follow on the fab in Arizona that's in progress and is going to come online pretty soon. And it's probably going to happen. Germany will ante up, and the European Union will ante up enough subsidies, and for political reasons as well, TSMC will probably announce sometime soon that they're building a big fab. So again, that's another one of those things that works both ways, right? It's good for Taiwan's tech companies. We hear politicians saying we need to save Taiwan because of its role in the semiconductor industry or the tech industry more broadly. But then we also see politicians and industry saying maybe it's not such a great idea for all that production to be located in one place.
But also it means you're getting a lot of visitors. As we discussed when we last spoke on this programme, you had former UK Prime Minister Liz Truss there. Since then, I think you've had Malcolm Turnbull, the former Australian Prime Minister, in Taiwan. What's he been doing and saying there?
Yeah, well, on the topic of resiliency, he spoke at an annual forum of a NGO that's focused on that very topic in the Asia Pacific. So it's nice to see somethings or somebody's coming here. Often they're paid to come here. Often they say things that they didn't say when they were in office, so we have to keep that in mind as well. But this is also not just an international issue. We should keep in mind that this is highly linked to Taiwan's upcoming election next January, in the sense that the ruling party, the DPP, outgoing President Tsai and her successor, William Lai, if he wins the election, as you alluded to, they want to internationalize these issues, right? They want to tell the voters that the world cares about Taiwan, and we're the best party to continue operating that model of foreign relations. They bring these foreign VIPs here to speak, and then claim a foreign policy or public relations victory. So, yeah, it's on the one hand, it's wrapped up in the geopolitics or the global geopolitics, but all politics being local, it's highly correlated to Taiwan's local national election as well.
And there's a lot of interesting things going on ahead of that. I noticed yesterday William Lai, I think he was asked by a journalist, wasn't he, about who he would most like to have dinner with, and he said President Xi Jinping, which caught the attention of China. They weren't very pleased by that comment.
If I could take some credit for that, that was actually at an event by a student-run organization that I help advise here in Taipei, where we had 2 out of the 3 presidential candidates came. William Lai, former Taipei Mayor Ko Wen-je. Unfortunately, Ho Yo-i of the Nationalist Party had a prior engagement that day. Actually got a lot of negative media attention for not showing up. There's a lot of focus on that comment, but I'll tell you, having been at the event and hearing the candidates speak and watching the students ask questions, the good thing and the important thing to keep in mind is this is also an exercise in democracy, and hearing the students ask very detailed questions about policy issues. It's just good to see. Whether or not China will agree to the dinner invitation remains to be seen.
I think I know the answer to that. Now, while everyone's rushing over to Taiwan, the Wall Street Journal is warning about business travel to China, and basically saying the rules have changed now for executives planning to travel to the country. What's been the reaction to that?
This is not really a new issue, though, right? And those of us who have worked in the region, we're familiar with some of the more prominent cases that have been in the news going back many years for corporate executives from multinational companies, whether they were Chinese nationals or foreign nationals, who've been detained as a result of business disputes. It's not new that as a result of something more in the nature of a political dispute that companies have gotten wrapped up or stuck in that kind of situation as well. And although it's been getting a lot of focus lately, the data collection issue, that's also not a new issue. We're familiar with some of those prominent cases going back a number of years as well. But it gets reported as there is this heavy crackdown of some sort going on, and companies just have to continue to consult with whether that's internal counsel, internal security, or external advisors, and comply with the law. That's the risks and the challenges of doing business in certain countries, including the mainland, and high risk, high reward. But we see companies also make some decisions that albeit in hindsight, you say, "My gosh, what were you thinking?" And if you're head of security is a former CIA agent and you're broadcasting that publicly, that's probably not the best image you want to have when you're doing business in China.
But do you think executives of overseas firms are really pulling back now on their trips to China and questioning, do I really need to go at all?
There's a little bit of that, but look, we saw this big forum with Mr. Diamond from J.P. Morgan Chase. Elon Musk has been in China, so somebody might say, "Well, they're not going to arrest Elon Musk. He's a big investor." Fair enough, but he's they do have to consider day to day. The executives below the level of Elon Musk face certain risks, and they live with those risks. So part of this is just being prudent and complying with the law, and refreshing yourself as well. What's the latest developments in the law, and as I mentioned, looking at your personnel is also important about this, and you have to consider that maybe certain people are not the best image you want to have for doing business in China, and that is subject to change over time and something that needs to constantly be reviewed.
I presume also, as well as your own physical security, you've got to think about digital security as well. What have you got on your laptop, on your iPhones, that could be viewed by authorities once you're in the mainland?
Yeah, you're absolutely right. And I would say that this also is not a new issue, whether you were traveling to other frontier markets or China or Russia over the years. This is always something that multinational corporations or even SMEs should be thinking about. This also happens in other parts of the world. People lose USB sticks when traveling anywhere. It always surprises people to find out that when they enter the United States, their computers and phones and USBs and storage media could be searched by U.S. Customs right there at the airport. This has been litigated many times in the U.S. courts, and at least up to now, the courts have decided on the side of the government. So prudence is the rule here. But yeah, of course, you should practice good IT security. And again, it's one of those things that companies shouldn't be lazy about. You should constantly refresh your internal knowledge.
Ross, it's always good to talk to you. Thank you very much for your insights this morning. That's Ross Feingold, who's Business Development Director at SafePro Group over in Taipei. Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Francis Lun, the CEO of GEO Securities, and John Schofield, Managing Director of Tempus Investment. With a view from Australia is Toby Lawson, Director at Staten Advice. Bye for now.
Money Talk